Ever wondered how a major move by a prominent real estate firm reflects the broader market trends? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Colliers International, a global leader in commercial real estate services, has announced its plans to relocate to a new office on the 13th floor of the Stewart Tower at One Market Plaza in San Francisco. According to the San Francisco Business Times, this move signifies Colliers' confidence in the potential renewal of the San Francisco market. The firm's managing director stated that the relocation is a testament to their belief in the city's commercial real estate prospects. This relocation to One Market Plaza is part of Colliers' strategy to establish a new flagship presence in the Bay Area, which they see as a market poised for recovery and growth. The decision comes amid a backdrop of fluctuating office space demands and changing dynamics in urban centers. As the city continues to navigate post-pandemic shifts, Colliers' move could be seen as a bet on the eventual stabilization and resurgence of San Francisco's commercial real estate sector. While San Francisco's commercial real estate market is seeing signs of renewal, let's pivot to what's happening in the Kitchener-Waterloo region in Ontario. Unlike San Francisco's urban challenges, this region is experiencing steady growth in its multifamily and industrial sectors, driven by tech expansion and a robust local economy. The contrast between these two regions highlights the diverse factors influencing commercial real estate markets across North America. Tony Messia of the Charlotte Ledger reports that the third quarter saw a notable rebound in office and industrial construction starts in the Charlotte area. Despite the sluggish pace in the apartment and retail sectors, the office and industrial segments marked their strongest quarter in 2 years. This uptick provides a sense of optimism for the commercial real estate market, despite the challenges posed by higher than usual interest rates, which have made securing financing more difficult compared to previous years. South Florida's commercial real estate market has been thriving this year, with the region experiencing its best pace in 3 years. According to Tom Hudson's report, the pace of commercial building sales across the industry's 4 major categories has grown over the first 3 quarters of the year compared to the same time last year. Despite ongoing concerns about the value of office buildings, the sales of regional office buildings have totaled almost $2 billion so far this year, based on data from the Miami Association of Realtors. Nearly $10 billion of South Florida commercial real estate changed hands between January and September, marking the strongest performance since 2022. The Realtors Association's report highlights that commercial sales volume has steadily increased since 2023 amid a challenging economic environment, reflecting investors' positive long-term outlook in the Miami metro market area. Notably, the biggest deal in the quarter was the purchase of a shopping center in Sunrise by 2 out-of-state investment firms. This was part of a larger 2-state portfolio of shopping centers anchored by public supermarkets, with additional buyouts in Broward and Palm Beach counties. The multifamily market has seen the most investment, with tens of thousands of new apartments under construction as the housing market remains tight. Vacancy rates are below the national average across the major counties in the region. The median price per square foot for a multifamily building has surged by at least 75% since before the COVID-19 pandemic. 2 of the largest third-quarter purchases in Miami-Dade and Broward counties were for apartment buildings. The office market continues to show resilience despite concerns about remote work reducing demand. Law firms renewing leases helped absorb space in downtown Miami, with more than a third of office leasing last quarter attributed to the legal industry. The Realtors Association credits this buyer interest for increasing median sales prices per square foot, a key real estate metric. Miami-Dade office rents have risen between 6 to 8% from a year ago, depending on the building's quality. Florida's recent elimination of the state tax on commercial leases, effective October 1st, has also been a significant development. Previously, a 2% sales tax was levied on commercial leases, making Florida the last state to impose such a tax until now. However, the industrial space has faced challenges due to volatility in import tariffs. A warehouse complex in Doral sold for $130 million, making it the second largest regional commercial real estate deal during the quarter. Despite this, the median price per square foot for industrial space has been flat to lower across the region through the third quarter. possibly due to recent tariff increases. Hanley Investment Group Real Estate Advisors, a national real estate brokerage and advisory firm specializing in retail property sales, announced the successful execution of a breakup strategy at Center Point Marketplace in Santa Clarita, California. They represented the seller and both buyers in two separate off-market retail transactions totaling $33.8 million. Vice President Sean Cox and Executive Vice President Kevin Fryman of Hanley Investment Group represented the seller and developer, Spirit Properties, Limited of Santa Clarita, and both buyers in the two transactions. The most recent transaction involved the sale of a two-tenant property occupied by DICK's Sporting Goods in Burlington, located at 26,583 to 26,591 Carl Boyer Drive. This property was sold for $25 million to an institutional investor. Sean Cox mentioned that they generated multiple competitive offers from institutional buyers and private 1031 exchange buyers to maximize value for the seller and secured an all-cash real estate investment trust buyer. The property's location, tenant strength, and recent lease activity made it a compelling fit for institutional capital seeking durable income and long-term stability. DICK's Sporting Goods recently extended its lease and remodeled its store, while Burlington assumed the lease from Joann Fabrics following the retailer's bankruptcy. The two-tenant property spans 83,953 square feet and benefits from affluent demographics, with an average household income of $144,000 within a 5-mile radius. Previously, Hanley Investment Group represented a Washington-based 1031 exchange buyer in the acquisition of a 30,624 square foot, new construction, single-tenant Sky Zone trampoline park at 26,583 Carl Boyer Drive, also located within Center Point Marketplace. The property sold for $8.75 million. The buyer, who had recently sold a gas station, was seeking their first retail investment. Hanley Investment Group sourced the opportunity through its developer network and closed escrow prior to the tenant opening for business. Sky Zone, a national indoor trampoline park brand catering to families and youth, is shadow-anchored by Walmart and Sam's Club, with co-tenants including Dick's Sporting Goods, Burlington, and a future Quick Quack car wash. Sean Cox stated that these transactions reflect the strength of their developer relationships and their ability to source off-market opportunities that align with buyer goals. Closing escrow, prior to tenant occupancy and securing top-tier pricing in a competitive environment speaks to the strategy's precision and execution. Kevin Fryman added that investor appetite for newly constructed, single-tenant net lease assets backed by nationally recognized tenants in high-growth markets remains strong. This breakup strategy allowed them to unlock greater value for the seller by matching each asset with its ideal buyer: an institutional investor for the multi-tenant property and a private 1031 buyer for the single-tenant opportunity. Investia Capital, a private equity real estate firm based in Downers Grove, Illinois, has recently launched Indvestia Fund 1, a $5 million investment vehicle. This fund offers accredited investors diversified exposure to institutional-quality commercial real estate across the Midwest. The fund is designed to target 8% annual cash-on-cash returns and 18% internal rates of return through investments in value-add retail, medical office, and high-yield debt. With a minimum investment of just $25,000, Indvestia Fund 1 allows investors to participate in multiple projects across various asset classes and markets within a single tax-efficient structure. The fund has already identified 3 investments in different stages of due diligence, enabling capital to be deployed and start earning immediately. Vic Mehta, the founder and principal of Indvestia Capital, stated that their goal is to offer Wall Street-level investment opportunities to Main Street investors. By focusing on recession-resistant sectors like retail and medical office, the firm aims to provide stable income, tangible value, and long-term growth potential. Indvestia Capital has a proven performance track record, having never issued a capital call, missed a distribution, or failed to deliver a profitable outcome since its inception. Previous projects in Illinois, Indiana, Louisiana, and Michigan have delivered annualized returns of up to 40%, underscoring the firm's disciplined underwriting and value-driven approach. Indvestia Capital, founded in 2020 by Vic Mehta, specializes in acquiring, repositioning, and syndicating high-performing commercial real estate across the Midwest. With over 300,000 square feet owned and operated, the firm focuses on stable, recession-resistant assets backed by creditworthy tenants and long-term leases. Indvestia has over 85 investors across 15 states in the 17 syndication deals it has completed to date, including 4 that have gone full cycle with positive results. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.